That's a very interesting answer. Talking about how Africa looks bright, only in 2023, Africa managed $1 billion of debt and equity funding just for productive financing. So productive financing can be divided into three verticals. The first vertical talks about non-asset backed unsecured lending, which is our buy now pay later microloans, as we were discussing. The second vertical is non-asset backed productive financing, which is going towards, as you were saying, purpose driven loans like SMEs and merchant cash advance and agent liquidity management. But the third vertical is asset backed productive financing, which has pocketed $750 million of the $1 billion funding that Africa got because of its compelling risk adjusted ratios. So definitely technology has a very big role to play in Africa at this point of time. But how do you leverage tech to mitigate credit risk? As in, how do you profile your customers in a way that makes a business like this viable?
So just to think about it from a principles of credit standpoint, so I just talked about all the different data sources that are needed for us to better understand the customer, profile them. But ultimately, all that information is going to be distilled into three things. Whether you have a visibility on the cash flow of the customer, do they really have some sort of an ability to pay? The second is, do they really have either the intent to pay, or do we have the ability to deduct the money from the account as the money comes in? Because one is to try to model the intent, but the easier thing to do is to deduct the money from the account when the cash flow comes in. So you are not taking the risk that the customer would choose not to pay because you're deducting the money. So that ability to deduct, the standing instruction, auto debit, whatever you want to call it, that capability is a very, very powerful capability from a risk management standpoint. And the third thing is, what are you using the money for? I mean, are you using it for productive purposes? Are you investing in a agricultural farm? Are you farming something? Are you creating? Are you running a business, or are you primarily using it for consumption? And within that, are you buying a home that is productive? Are you buying a vehicle? Or are you just using the money for some activity which you don't want to disclose? Let's put it that way, right? So depending on that, I think the risk does vary. And the thought process that we have is, if we are able to understand it from these three perspectives across the different data sources that we have, we can form a fairly good assessment of the risk, right? Now, obviously there are gaps with respect to what information we have and what we would like to get. And that is where we have thought about the concept of a credit ladder. What is a credit ladder? The basic idea here is, somebody comes in and says, okay, I have a mobile money transaction of $100. If somebody says they want $1,000 just based on the $100 of transactions, I would not be able to support that. Because it is not, I don't have the cash flow visibility. I do not, even though I have some ability to deduct, I can only deduct $100, right? So the point here is, I will start by giving him, say, $30 out of the $100 and say, okay, I'll give you $10, $20, $30, right? Whatever that need is to begin with. But then you have the option as a customer to build that credit ladder over time. So you pay back the $30 on time. Next time I'll give you $50. After a few loans, you can probably go up to $100, right? And maybe your wallet size also increases. Instead of $100, you also show that, okay, I have another $1,000 lying in my bank account. I have a job. I am getting paid $2,000 a month, right? The more information I have about the customer and the more visibility I have about those customers, I will be able to underwrite them based on their repayment track record over a period of time. So the way I would look at it from a risk standpoint, the way you mitigate it is basically start with a smaller ticket loan, look for experience, educate the customer, and then build that credit over a period of time through a low and grow strategy, as it's called. And that allows us to build the credit ladder and enable us to drive customers who can potentially reach the top of the ladder. So not everybody will probably, who you start with $10, $20 will reach, $10,000, but a good chunk of those customers have the opportunity to scale the credit ladder and become bankable over a period of time. So that's the second piece that I would say from a risk management standpoint. Now, there are other things that we have not tried, which I think is common in Africa and I think in other emerging markets. This is the concept of group lending or social lending, or chamas as it's called. And I think this is basically a trust-based network where a group of people get together, they contribute a certain amount of money every month, and then they use that money to kind of give credit or borrow. One person out of that group borrows every month, right? Effectively, that's like a self-funding kind of model. We have not tried that, but we believe that the trust-based network aspect of it is very powerful. And one of the things that we are looking at is an opportunity to support those groups from a credit standpoint and use that information about somebody who's been part of such a group and their repayment track record, and use that as a way to reward somebody who has been part of a group like this over a period of time. So just to summarize, the idea here is there are three parts to how we mitigate the risk. One is developing a good customer profile across those four pillars that I mentioned, right? Second is having the right product construct with respect to having the visibility in terms of cash flows, ability to auto debit, and having an understanding of what the credit is used for, and having those products kind of designed to meet those needs. And the third piece is having an approach which is more conservative, where you start with smaller amounts and then build it up over a period of time. So the customers who remain loyal and who are engaged and who are able to kind of work with the terms and conditions that we want to kind of have them follow will grow over a period of time along the credit ladder. So that's basically how we have tried to mitigate the risk from a emerging market standpoint, particularly for unsecured lending.